Chapter 2, Accounting Concepts and Conventions. Learning Objective. After completing this chapter, you should be able to first discuss the key accounting concepts and conventions and explain the key characteristics of accounting information. Accounting concepts and conventions are the basic standards or guidelines regarding the application of accounting rules. These concepts and conventions to ensure that the business would have a standardized methodology in preparing financial reports, and it promotes comparisons of financial results from industry to industry and from year to year. This accounting concept and convention act as a foundation for the preparation of the financial statements of an enterprise. Okay, here we have seven accounting concepts and conventions that we need to know. First is business entity, second going concern, third monetary measurement, fourth accrual concept, fifth comparability concept, sixth neutrality concept, and last one is materiality concept. Business entity. Business entity means a business and its owner should be treated separately as far as their financial transactions are concerned. This convention seeks to ensure that private transactions and matters relating to the owners of a business are segregated from transactions that relate to the business. Other term for business entity is accounting entity. Second, going concern. In accounting, a business is expected to continue for a foreseeable future. It is assumed that the business has neither the intention nor the need to liquidate or curtail materially the scale of its operations. A bankrupt company or a business near bankruptcy is the opposite of a going concern. This has important implications for the valuation of assets and liabilities. The concept of depreciating and amortizing assets is based on the idea that businesses will continue to operate for a foreseeable future. The going concern concept assumes that the entity will continue to operate indefinitely. Thus, the financial statements of a business are prepared on the basis that the business will continue for the foreseeable future, or in other words, that it is a going concern. If the accountant has some reason to believe that the business owner does not intend to continue the business, or that the business cannot continue to operate, it would of course be fraudulent to prepare the accounts on a going concern basis. Third one is monetary measurement. Only business transactions that can be expressed in terms of money are recorded in accounting, though records of other types of transactions may be kept separately. Accountants do not account for items unless they can be quantified in monetary terms. Items that are not accounted for unless someone is prepared to pay something for them include things like workforce skill, moral, market leadership, brand recognition, quality of management, etc. For example here, accounting does not show whether the firm has good or bad managers. There are serious problems with the workforce, or The government is about to pass a law which will cause the firm significant additional expenses in the future. Accounting can never tell you everything about of a business. It's just record all the transactions that can be expressed in terms of money. Next concept is accrual. Accrual concept requires revenues to be recognized when they are earned and not when they are received in cash. For expenses, the concept requires expenses to be recorded when they are incurred and not when they are paid. From this concept, profit is recognized only when it is earned. Hence, an advance or fee paid is not considered as revenue until the goods or services have been delivered to the buyer. Specifically, under accrual concept, the transaction is recognized at the point of sale or transfer of legal ownership, even when the actual payment may not arise until several weeks or months. Comparability concept. Accounting information is comparable when accounting standards and policies are applied consistently from one period to another and from one region to another. The characteristics of comparability of financial statements is important because it allows us to compare a set of financial statements with those of prior periods and those of other companies. In order to make decisions, users of financial statements need to compare the information presented over a time period as well as between business entities. This is only possible if the accounting methods are used consistently from time to time. Neutrality concept. Under this concept, financial statements must be free from bias or errors, either deliberately or systematically. Neutrality means the financial statements were prepared to reflect a balanced view of the affairs of the business, not with any purpose to influence certain decisions. Deliberate bias is where management intentionally misstates the financial statements, while systematic bias happen when the accounting systems inherently develop a tendency of favoring one outcome. Materiality concept. In accounting, an item should be regarded as material if it would influence the decision of an informed investor. The materiality of an item depends on its amount and its nature. Since the preparation of accounts involves a high degree of judgment, the concept of materiality is an important issue for users of financial accounts. For example, purchase of items like pen, stapler, punching machine, etc., though can be treated as part of assets considering their durability and span of life, but it is not practical to maintain separate ledgers. Under materiality convention, such low-cost items can be treated as an expense for the period. Okay, now we will continue with multiple choice questions. Number 1. According to the accrual concept of accounting, financial or business transaction is recorded: A. When cash is received or paid. B. When a transaction occurs. C. When the statement of financial position is prepared. And D. When profit is computed. Number 2. The FB Advert Excel provides advertising services to an investment company in the year 2017, but received the payment in the year 2018. FB Advert Excel recognizes this revenue in the year 2017. The action of FB Advert Excel is justified by A. The comparability concept, B. The accrual concept, C. The business entity concept, and D. The going concern concept. So the answer is B. Okay, just now the question number 1, also the answer is B, when a transaction occurs. For question number 2, the answer is also B, the accrual concept. Okay, next, question number 3. A business is a going concern if A. Its statement of financial position shows a strong financial position. B. Its statement of profit or loss for the current year shows a huge profit. C. There is no evidence that it will or will have to cease operations with the foreseeable future. And D. It is company listed in Bursa Malaysia. Okay, the answer is C, going concern concept. Okay, number 4. Which accounting concept or principle states that the transactions of a business must be recorded separately from those of its owners or other businesses? A. Accrual concept, B. Going concern concept, C. Monetary measurement concept, D. Business entity concept. Okay, here the answer is D. Business entity concept. Number 5. Which of the following states that a transaction is not recorded in the books of accounts unless it is measurable in terms of money? A. Accrual concept, B. Going concern concept, C. Monetary measurement concept, and D. Neutrality concept. The answer is C. Monetary measurement concept. 6. The revenue is not recognized until it is earned and realized, or at least realizable. To which accounting principle or concept this statement belongs? A. Business entity concept, B. Accrual concept, C. Going concern concept, D. Monetary measurement concept. The answer is B. Accrual concept. Thank you very much.